Well, this is Noah McIntosh again with McIntosh Associates here for your weekly market update. Well, the never-ending story. It seems like we keep talking about the same thing over and over, the war in Iran. Sadly, this week has offered few solutions to the conflict. What was supposed to be 4 weeks is now going into 4 months, kind of like a bathroom remodel that just won't end. It all started back on February 28th, and the bombing stopped after about a month. For 2 months now, we've been hearing that a deal is imminent. But another week has passed, but the same close to a deal rhetoric, but so far nothing's been made public. Some new items get floated every now and then, but it's mostly just fodder for speculation. As we said last week, markets have largely moved on from the current situation in Iran. Earnings were good and we're coping with higher gas prices. The consumer is grumpy but continues to spend. Markets did get jittery last week with the potential for higher rates on the horizon. We shouldn't expect to get daily updates from the President, the State Department, and the Pentagon on developments with Iran, but it also doesn't seem we have a visible strategy to finish this. We threatened to start bombing again and get a deal is coming any day now in response, so we stand down. The best thing for the markets and the American people is to get this thing resolved once and for all. Well, jobs data remains solid. Jobs and earnings have really been the only standouts during this Iran conflict. Last week's Bureau of Labor Statistics jobs report for May was good, maybe too good. Expectations were for 85,000 new jobs to be created in May. The actual number was an increase of 172,000, more than double the expectations. The April number was also revised upward by an additional 64,000, going in from 115,000 to 179,000 new jobs. Unemployment was unchanged at 4.3%. The AP employment report was more in line with estimates earlier in the week, coming in at 122,000 versus the estimate of 120,000, but robust just the same. Meanwhile, the job openings and labor turnover survey on Tuesday showed openings jumped from a revised 6.89 million in March to 7.62 million in April. Strong job growth would normally be a good sign and positive for the economy, right? Well, not so fast. Markets had a nasty sell-off on Friday after some rotation from high-flying tech stocks earlier in the week. Once again, markets played normally good news into bad. What happened? Remember, the Federal Reserve has two mandates: price stability, i.e. keeping inflation in check, and pursuing full employment. The Fed is being faced with a choice. Given the strength of the recent jobs figures versus the continued inflationary prices due to conflict in Iran and rising global oil prices, it appears abundantly clear that the interest rates shouldn't be lowered, but that raising rates may be in order. The 10-year Treasury agreed with that assessment last Friday, and the yield jumped over 4.5% again. That got markets worried late last week, and it makes sense investors would get skittish, especially since it's been hovering at or near records. The drop started with a rotation out of the narrow set of high-flying chip and tech stocks into more defensive areas like banks and industries. Then, sensing potentially higher rates would negatively impact future earnings, the entire market took it out on the chin on Friday. The decision to step back was made easier by the fact that we've been hovering around all-time highs. The downside is large if something were to go more sideways in the Gulf or if Fed signals higher rates ahead. But missing out on a little more than the upside isn't as painful, at least that was the thinking last week. Well, coming in this week, no data is scheduled for Monday. Tuesday will be pretty mundane with the U.S. trade balance, existing home sales, and wholesale inventories. The action will pick up on Wednesday with the fresh readings of the May Consumer Price Index, expectation for inflation to keep rising. We'll also see the MBA mortgage applications. We'll see the latest producer price index on Thursday. It seems likely PPI will climb more, especially with oil still hovering around $90 a barrel. Consumer sentiment, which has been in the tank for some time thanks to inflation and high gas prices, will provide a muted end of the week. Well, that's it for your market update for this week. Again, any questions, please give us a call at 989-692-2200. And as always, resources at focuswealthplan.com. Have a great week.